Hi, today we are looking at a SPAC with material revenue, historic revenue growth, profits. Whoa, you don't get that with a lot of these speculative SPACs. This is a real company that they're merging with. And I think the potential on the upside scenario is over 450% upside if they deliver, if everything works out. I haven't yet pulled the trigger though. So make sure to tune in throughout this whole video. And at the end, I discuss sort of the things that are holding me back from pulling that trigger. I want to know your thoughts on whether or not I should pull the trigger, whether or not you've pulled the trigger, your thoughts, what are your thoughts on these concerns that I call out at the end? And if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, and this is the whole reason for this channel. I'm looking for potential multi-baggers, those types of stocks that I think can potentially go up hundreds or thousands of percent over time. This is supposed to be a no-hype, mission-focused channel, and I'm not trying to say like to the moon. I'm saying, hey, let's try to take reasonable assumptions here and try to say in a hypothetical scenario, what could be the downside, what could be the upside. And as I look at OpFi Financial, or FGNA stock, FGNA is the SPAC that is merging with Opportunity Financial, which will be OPFI. I'm looking at what I believe is an asymmetric risk reward, yet I still haven't pulled the trigger. We'll get into that in just a second. So let's go through this deal real quick. And as you can see here, FGNA is the SPAC. They have about 240 million in cash, and it's being used to pay off existing shareholders that are seeing an exit. And it's worth calling out. FGNA sponsor is going to get 8% of this company effectively just for doing this deal. So they're heavily incentivized to do it. Currently around 800 million. That's the pro forma valuation. The reality is it's much higher once the stock starts appreciating just ever so slightly, just because there's so much dilution that happens at like 1150 and up. So currently FGNA stock, if it effectively de-SPACs in the coming months, it'll be OPFI. And what is OpFi? What are we looking at here? And so effectively, it's a business that enables personal loans. So these are not guaranteed products. These are personal loan products. And it usually, you're looking at relatively small amounts, talking about, $1,000 to $2,000 for people that are facing, typically facing a financial emergency. 80% of these people are applying online on their phone. And when they go through the different journey to try to figure out how can they get some sort of emergency financing, what I love that OpFi does is they have this turn up process where they perform this diligent search on customers' behalf for sub 36% APR. Now that's 36% APR. That should make your eyes like pop out, where you go like, holy smokes, that's like usury what you see over here. We'll talk more about that in a second. But their first look is to say, hey, based on your financial metrics, based on your customer profile, could you get a sub 36% personal loan? And 92% of the time, no offers of credit are returned, i.e., let's say the Wells Fargos of the world that could provide, let's say, a high single-digit personal loan rate, they're just not available. They're turning down these subprime credits. So this is subprime personal loans. And then they using artificial intelligence, make this instant decision within the next day, and getting with instant decisions with next day funding. So these folks that are facing some sort of financial emergency, it's COVID, your child needs a laptop and you don't have the money for it, for them to have their Zoom class, boom, you can make this happen. Or your car is breaking down, you need that money. And here's the part that really tickles my fancy over here is they talk about Zappos-like customer happiness. And I'm like, what? How can you compare effectively this very high rate personal lending product to Zappos-like customer happiness? And how do they make these faster decisions? So I'm very intrigued by this business model. And so how do you make faster decisions where people can get their capital within what seems like 24 hours? It's effectively powered by AI, looking at data points that, let's say, the traditional financial system isn't looking at. They're talking about 7 billion plus data points that they've looked at over time across millions of applications, 1.5 million plus loans. You're looking at a lot of repayments, looking at all these data points to try to figure out who can repay, who's actually a credit risk. And their models recommended approval of 29% additional loans at the same default rate as traditional financial models. So the models that, traditionally say, hey, you're subprime, we just can't approve you, they're saying, look, we're using a better algorithm that approves effectively little under a third more loans that have comparable default rates. So that is a big win for these subprime borrowers. And why does it have a superior value proposition? That's always what I'm looking for with this channel. That's why this channel is called Unrivaled Value, or excuse me, Unrivaled Investing, is I'm focused on trying to find companies that have an unrivaled value proposition. That's my full focus, is I want to find things that have something special that gives them the right to win and take market share, like OpFi has done over the last few months, or excuse me, last few years. And the key part is that they try to have the best product available with its simple interest. So this isn't compounding interest that's going to spin someone into bankruptcy. No origination fees, no late fees, no prepayment penalties. And you could see the relative costs on a effective APR comparison, where it's like, well, wait a second, if you're having a bank overdraft because of emergency, you're talking about the thousands of % fee effectively, and then relative to the amount. And then payday and title loans, that's somewhere between 200 and 300%. Lease to own is around 200%. And so then you compare that to OpFi, and so relative to these products where people might really need the money, it's actually cheaper to have something where your APR is somewhere between 30 and 160%. I think blended across OpFi's entire portfolio, it's around 130%. To way to understand this, so they say a cheaper, better product for non-prime, I'm thinking subprime loans, average loan amount of $1,500, average term months 11 months. So this isn't the type of thing that's going to string people along for 5-10 years. This is something where it's like, hey, you're going to pay this back this year, and we're going to figure out a way to make sure it happens. And wait a second, I'm thinking like 30 to 160% APR. Isn't that like insanely high? Isn't this definitely usury? Even if you compare it against, payday loans, which are 200 to 300%, like this still strikes me as really, really high. But then you need to have some context for what you're dealing with here. And, whenever you're looking at a loan, this is from their most recent financial filing, they talk about whenever you're looking at a loan, there are fixed costs associated with it, like originating the loan, servicing it, and collecting the loan. And these fixed costs are tied to the loan application itself. So when you get a smaller size consumer loan, these fixed costs are represent a much larger amount relative to the loan. So you have to charge more. And that's effectively what the Federal Reserve, so the US government, Federal Reserve published a report in August 2020 saying, look, for smaller loans, you need to have a higher APR just to cover these fixed costs. They say the break-even APRs are quite high for small loan amounts. Based on 2015 data in the report, a loan amount of $2,500 is necessary to break even at 36% APR. And they talk about for smaller loan amounts of, let's say, $600 loan, you might require an APR of 103%. So they're saying, look, this high fixed cost with small loan lending, you need to have the APR in order to even justify the business. So look, it's best obviously if you don't get into a position where you need this, where you need to take on a loan, with 100% APR. But people invariably do get stuck in this position. They do have financial emergencies, and unfortunately there's a lot of people in the United States that just can't afford unexpected big bills, and that creates a big problem. And yet, despite what I'd argue is potentially dire financial strait for the individuals that are considering these loans, they have best in breed net promoter score. So effectively people recommend OpFi. They have such a favorable experience. This has a higher score than Costco, Apple, Vanguard, the Ritz-Carlton. I mean, this is incredible. It's way higher than the average banking score. And so this just blows me away. Like, how is this even possible for you to have, for OpFi to have this type of score? Because this is the type of score in my mind that means you can win share over time. And I think the way they at least explain it is that it's really meeting the customers where they're at. So it's, easy phone or digital customer support, no prepay fees. It's better than the alternatives that you're looking at in terms of origination fees. It's more expensive, the alternatives, and they push to borrowers to cheaper options if it's available. So they're really in some ways advocating for these borrowers to say, well, wait a second, if you can actually maybe squeak by with a loan from one of the major banks or a local union or something that might be, 9-10%, that would be a huge win. And they direct you to that. And so I think having this where it's, you can easily on their website have a phone number, and it's listed here. They are. I've copy and pasted it here for you to see. I mean, that I think is a big win in today's society where, some people want to be on the phone, some people want to be able to easily access digitally, talk to someone online. There's a lot of options here, and I think this is really appealing to the users. They're meeting the users where they're at, and they're targeting a huge market. You're looking at 27 billion for these installment loans. You're looking at, and these are additional products that they're looking at, of effectively an OpFi card or salary tap, which effectively ties whatever loan product you have to payroll, and your payroll automatically repays the balance. But you're looking at like $100 billion market. So their market penetration is teeny tiny, yet they've continued to grow at a good clip. And as I mentioned already, there's the unfortunate aspect that 150 million US adults have less than $1,000 in savings. So this is the reality that a lot of these people will have unexpected financial bumps in their life, and they're going to need this money. And so how does this business model work? How does OpFi actually get people through the door, the digital door that, tells them, oh, okay, this is the place to get a personal loan. And so you could see historically direct mail, so effectively spamming people with those cards in the mail, used to be a large percentage of their business. Now it's only about 15%, but they figured out non-direct mail approaches that seem to be very effective and has lowered their cost of acquiring new customers over time. You can't quite read it very well over here, but this 84% represents search engine optimization, so people saying, hey, I need a personal loan, email marketing, customer referrals, and strategic partnerships with the following, let's say, loan aggregators online, where people say, hey, can you show me the best products that are available? And so they have dozens and dozens of different sites that effectively become a strategic partner or a referral source for them, and that's been a much lower way for them to acquire new borrowers that where ultimately they can make these loans. And you can see the cost per funded loan has dropped dramatically over time. Now that could start changing over time. Maybe they tap out the search engine optimization. It's something to think about. But overall, I'm impressed with the ability that they've had to lower their customer acquisition cost over time. Now, what's actually the financing model here? Where about 65% of OpFi's net originations were generated from loans from its bank partners. Now, 96% of this was from one bank partner, but they've slowly been diversifying with other bank partners. So FinWise was the main one. It's primarily effectively using these partners. It's not really a true bank partnership where they are interested in making these loans. I mean, these bank partners are non-exclusive, and the OpFi bank partners generally hold loans originated on our platform typically 2 to 3 days following origination. So OpFi acquires participation rights in such loans ranging from 95 to 100% of loans. So these banks aren't really interested in keeping it on their platform. OpFi effectively finances the vast majority of this loan. And so why is OpFi even using these banks? And we'll talk about that in 1 second. So is there an economic difference to use OpFi, where OpFi is directly financing it using their balance sheet versus using the banks? And they say the economic difference to OpFi in loans originated via the bank partnership model as compared to the direct origination model are immaterial and generally result from a minimal program fee paid to OpFi. So effectively they're saying, look, the difference between us making these loans and these bank partners, it's immaterial. So once again, why use the bank partners? And OpFi has shifted to bank partner model because its bank partners operate under federal law, which allows them to lend nationally based on their state domicile and facilitates a national product offering for the consumer while also streamlining regulatory requirements and compliance infrastructure, i.e., this by partnering with different banks, it enables them to effectively make loans. And where the banks aren't, while the banks technically are making the loans, it's really OpFi, because OpFi is the one that pays the bank. And so the bank's risk, it dramatically drops within 2 to 3 days of the loan. So it's really like OpFi is using these banks to make the loans. Now, it's effectively using the banks, and it's not without risks. And this is going to be a point that I'm going to talk more about at the end of this video, where on April 5th, 2021, they call out how there was a lawsuit with the Washington, D.C. Attorney General, for allegedly deceptively marketing high-cost loans with interest rates above the Washington, D.C. usury cap. The usury claim is based on an allegation that OpFi, which is not licensed in Washington, D.C., because a license is not required to service bank loans in the district, and that's what OpFi is doing, and not its partner bank, FinWise, originated these loans, and is therefore in violation of the district's usury law. So this gets back to the point, well, wait a second. Who's actually writing these loans? If OpFi effectively de-risks the bank within 2 to 3 days, isn't it really OpFi that's writing these loans versus FinWise? And so they're saying, well, wait a second, then really OpFi is the one that needs to be regulated, and because they're not licensed in DC, and they're marketing these loans that are above the cap, there's potentially this problem. And so I look at this as like, oh, you may not be able to get around these rules just by sort of using these banks. And we'll see how this plays out. You know, they're saying OpFi denies such allegations and intends to vigorously defend the matter. But FinWise has ceased, originating loans in Washington, D.C., and as a result, OpFi has ceased doing business in Washington, D.C. So this is a question of sort of how does this play out, and how does the regulatory environment sort of shake out, thinking, well, wait a second, if you de-risk these banks within very short order for the loans they make, who do you treat as actually the originator? And that'll be a question that will play out over time. But so far, the unit economics seem pretty favorable, where let's say you make a loan, and the revenue realized from said loan is, let's say, $1,700. And what are the different costs that go into it? The biggest cost is net write-offs, where you could see about $700 of the, let's say, $1,700 that you'd expect from revenue, gets written off. So you're talking about 30%, give or take, that's going to get written off. That means people that are like, hey, you know what, you gave me this money and I can't repay you. And ultimately that's a lousy situation where, this person's headed towards bankruptcy and they just can't repay these things. But then the other much smaller costs of this business model are the acquisition costs. And that's why it's so important to understand what's the funnel for acquiring new borrowers. And servicing costs, that's fairly straightforward. And the interest expenses, well, wait a second, this is an origination model where OpFi is putting, taking their balance sheet and buying these participation rights from banks. So OpFi is going to need to make sure they have the cash on the balance sheet. That said, effectively the return on the investment here is like 2x. So it does have very favorable economics over time. And you'll see that with their business model here, which is that their revenue has grown. And these are actual figures. Their revenue has grown from 70 million to 323 million in just 3 years. I mean, that is some incredible growth that you're looking at. And very real margins. I mean, 30% plus EBITDA margins, very real profit margins, adjusted net income, that you can see here, 50 million plus in net income. So, I mean, this is a real business, fast growth and profits. This is what I like to see. This is not a speculative SPAC where it's much harder for me to sort of size up, like, could this business grow over time? I mean, look, there's no way the personal loan market is growing by 5x in this time period. This reflects they're doing something special that is taking market share. Could you continue tapping share, taking share in a $100 billion market and get to $1 billion in revenue or more, get to $2 billion in revenue like they're also projecting? Now, what about the valuation? And a quick plug, if you will, where, if this is your first time tuning in, once again, my name is Daniel, you're watching Unrivaled Investing. And, if you enjoy learning about potential multi-baggers, I do appreciate that thumbs up and make a point of subscribing. And if you want to follow my personal journey as I look for potential multi-baggers, go to unrivaledinvesting.com, click on Journey, and then that first week of the month, I call out my full portfolio of ideas and I walk through the thesis of my top holdings. And during the month, I call out one potential multi-bagger idea, the type of company that I think has hundreds or thousands of percent potential upside over time. For example, my May potential multi-bagger was a company that trades below liquidation value and I think has 2 to 3x upside. So enough about that. Let's go back into OpFi, thinking about their financials and their valuation. And so as I look at their valuation, relative to some of these other setups, this is actually very interesting, potentially even compelling, where you see The shares outstanding figure I'm using, you have to read the footnotes on here to get to this. This assumes the stock price actually starts to appreciate a little bit. I'm being a little conservative here because you could argue, hey, I should just be using 80 million for the shares outstanding. The reality is if you really want to be assuming the stock price goes much higher in the future, you have to consider all the dilution that at least could exist right now and figure out what the adjusted shares amount outstanding would be. So that's closer to 123 million. So take around the current share price of around $10, 123 million shares outstanding. So that gets you to around a $1.2 billion market cap. You can see their historic revenue growth, which I already called out. Now it did slow down a bit in 2020, which we'll discuss more in a second, but they are penciling out pretty strong continued growth in 2021 and in the years ahead. I put a range where I discount what management has projected of about 10% growth and an upside of about 30% growth, which is closer to management's target. The margins over time, penciling out somewhere between 27.5% and 32.5%, which is in line with what they've historically done in the last year. So I think this business model can contain, this is also in line with what management has targeted. So once again, 10 to 30% growth in 2021, 27.5% to 32.5% operating profit, slap on a 25% tax rate, and you can see their implied net earnings for 2021 is potentially 73 million to 102 million, in which case you're looking at a stock with an implied forward earnings multiple of, let's say, 12 to 17 times. Now that could smell really good if you actually deliver on what management is targeting of, let's say, 30% growth. I mean, if you have a 12 times multiple and 30% growth, that is a very rich and attractive setup. Now, the setups that I don't like are when the valuation multiple is way higher than the growth rate. When you have the growth rate way higher than the multiple, now I'm definitely getting interested. And so then the question is, well, hey, can they continue to deliver on executing on this $100 billion market opportunity, continue to grow using artificial intelligence to make intelligent loans that traditional lending models wouldn't do? And so I use a growth rate assumption over the ensuing 4 years after 2021 of 15 to 35%. And then an N multiple of, let's say, 12.5 times to 20 times. And that range gets you 30% upside in the downside scenario to 450% upside in the high scenario. So this is a scenario where if people get excited about this and say, hey, they have a model that's working, in 5 years from now, people could give it a full multiple, maybe even higher than this, in which case you're looking at nearly 500% upside. Now, there's, I would caveat this. This is just a hypothetical framework. This is how I'm currently considering it. Could the stock price go way higher or way lower? Absolutely. And this is the reason why there's two parts to the valuation whenever I think about it. There's the valuation component, and then there's sort of like, well, wait a second, what's the blow up risk component? Is there a greater degree of blow up risk or something just sideswiping you and sort of ruining the thesis? Even if you're able to show great numbers on here, what about that sort of blow up risk that makes you uncomfortable? And let's talk about the things, because normally when I show you financials like this type of asymmetric risk reward, I'm all over. This is the type of thing I'm typically trying to buy for myself. So in full credit, I want to call out the unrivaled investing, the unrivaled nation that called out OpFi to me and said, hey, Daniel, you definitely got to check this out. This smells like asymmetric risk reward. So thank you to all that called that out, the unrivaled nation. And so I'm looking at this and I'm saying this is compelling, but why haven't I yet pulled the trigger? And there's a couple of reasons why. And so the first is this whole banking, using banks versus actually partnering with them. It does make me concerned about the regulatory environment over time, like that Washington, D.C. lawsuit that you had that popped up in April 2021, where it's this concern of like, well, wait a second, these banks are really just using their license so that you can make a loan and you're buying the participation interest. So if you're the one that's effectively making that loan, like that shouldn't you be the one? Shouldn't OpFi be the one that gets regulated? So it makes me worry that regulatory framework could change in the future. That would make it harder for them to do business. The second key component that makes me wonder where this whole industry is going over time is that what if a bank recognizes this, a bank with deposits recognizes like, wait a second, this is the way the world is going. You need to have artificial intelligence to offer these banking products. Like, we shouldn't let this one-off company that has to use some sort of, borrowing facility to eat our lunch and make these personal loans. Like, we should get into this market. And so it makes me wonder, like, what happens when a bank that has a depository base, or a credit union has a depository base that says, wait a second, we are going to leverage this artificial intelligence and try to do this ourselves. Now, admittedly, it's not easy to sort of recreate these models, but if you were to have someone that were, let's say, to acquire OpFi or a company similar to it, that bank would then have some significant advantages relative to OpFi. And there are two advantages that immediately come to mind. One of which is that you have a financing cost, because these banks, what is a clear attribute that these banks have? What is a key asset? It's the deposits. The deposits are traditionally low interest bearing assets for them. It's technically a liability on their balance sheet, but when someone comes in and deposits money with that bank can then redeploy it in higher interest assets. And so I'm looking at this and thinking, wait a second, here it is, OpFi has to borrow money and has to have a facility to sort of grow their business. What if OpFi competes one day against a bank that has deposits, low cost deposits? So now you'd be at a disadvantage in terms of making that product. And then two is that banks, you walk into your local bank or what have you, you have a customer acquisition cost advantage, because people are saying, hey, I just want to go check out my local bank. Oh, I need a personal loan. Let's see what's there. And so what if you have banks start offering the full spectrum of loans from prime, which is where a lot of them are today, to subprime as well, enabled by, let's say, the OpFi or an equivalent. And so that's the challenge that I'm facing, or I'm looking at with OpFi, is they seem to say, hey, we're using banks, we're using them. We're not truly partnering with them. We're not enabling those banks. We're using their whatever their licenses are to make loans that we're interested in making, that effectively that we acquired. Whereas here it is, if a bank were to do this, they would have two potential advantages, both from a financing cost perspective as well as acquiring new borrowers. And I look at Upstart, and I've done a couple of videos on them. The first video, I was a little more skeptical on their business model. The second one is sort of looking at their results, and the truth is they have started to successfully pivot their business model, because they originally had the pure like, hey, we're going to do it ourselves, to over the last couple of years to saying, hey, we are going to enable banks. And that's exactly what my fear is here, is saying, hey, what if you have some company enable the banks, enable the credit unions, and say, hey, we will make this part of the product for you. We'll make it so that we can white label your personal loans, but it'll be using our technology. And you can see that with the data from the first quarter results for Upstart versus OpFi, where Upstart posted originations that were up over 100% year over year, versus OpFi, which had negative 20% origination dollars year over year. And keep in mind, Upstart is much bigger than OpFi as well. So that is a red flag. When I'm looking for companies that are potentially unrivaled, it's saying, well, who's growing relatively faster than who and why? Now, OpFi did decline. They're really calling out, well, wait a second, you're getting all the stimulus, people are getting the checks in the mail, and if you're getting $1,000 check in the mail, you're not going to need a $1,000 personal loan. So that's the reason why these originations declined. But their business later on in the year, let's say in April, actually started picking up dramatically for OpFi. So I'm looking at this and I'm saying, oh, okay, maybe first quarter was just sort of a whiff, but whatever Upstart's doing here with partnering with all these banks is clearly working for them, enabling these banks versus just using their license to make a loan. I'd say the final thing, at least for now, that's holding me back with OpFi or FGNA stock right now is that ultimately OpFi was established in 2012. And you'd want a business model that has seen multiple cycles. And I'd argue the COVID meltdown of March 2020, that was not a full market cycle, as the government intervened very, very quickly. And so I would want to make sure I have a company that has an AI or artificial intelligence machine learning that's looked at data across many, many, many market cycles. And I'm just not quite sure these new models might be up to it. If you have, let's say, another great financial crisis or something like that. What are your thoughts? Given their growth and valuation, is it worth pulling the trigger? Where clearly, if they execute and if the market gives them the benefit of the doubt 5 years from now, you potentially are looking at 400, 500% upside over time. I personally, in my own personal investment portfolio, haven't yet pulled the trigger. I haven't yet invested. I still, these risks sort of turn me off, and that's why I want to hear your thoughts. Say, Daniel, hey, you're completely blowing it out of proportion, or hey, here's the reason why I pulled the trigger. Ultimately, as I look at my personal portfolio, I'm looking at my May 2021 potential multi-bagger, and I just prefer a type of setup where it's like, hey, this is trading below liquidation value, and it still has 200 to 300% upside potential. Whereas this, I said, the downside is, let's say, 30% upside. But if, let's say, the regulatory environment changes dramatically, in that case, your valuation could really get hurt. In which case, this hypothetical valuation model gets thrown out the window, because that, I'd argue, that blow up risk, or that risk that that Upstart is enabling banks and you're going to get sideswiped, that's going to disrupt this business model. So these are questions that I'm struggling with, and I'd say the devil's advocate to this is, well, wait a second, Daniel, like, you're looking at $100 billion marketplace. You could have Upstart and OpFi win as well. So maybe that's the case. What are your thoughts? Leave a comment below. Thanks for tuning in. If this is your first time watching, please make a point of subscribing and hitting that thumbs up button. Thanks so much.